Thank you for coming bright and early to our panel about investing in infrastructure. So we will be talking both about investing in infrastructure for crypto trading as well as the broader blockchain crypto assets infrastructure. So if we want to start off, could you introduce yourselves and about your funds and how you guys structure yourselves?
Good morning, everyone. My name is Kyle Samani. I'm a co-founder and managing partner at Multicoin Capital. We're an investment firm based in Austin, Texas with 14 people. We run a hedge fund and a venture fund, and we invest in equity, things like market infrastructure. We invest in tokens, long and short on the public markets. Have pretty deep relationships throughout the ecosystem with counterparties, exchanges, prime brokers, custodians, all the major market participants, and are pretty deeply plugged into the entrepreneur community on the early stage side. We invest all the way from two guys or gals with an idea, all the way through Bitcoin and everything in between.
Hi, everybody. I'm David Pakman. I'm a partner at Venrock here in New York. We're an early stage venture capital firm. We invest broadly in technology. About a third of my time is spent on crypto. In crypto, we've partnered with coin fund guys out of Brooklyn who've been super helpful to us. And through them, we've invested in a number of projects. We've also invested directly in equity offerings in some infrastructure companies we'll talk about today, as well as at the DApp layer, which needs infrastructure to succeed. So I'm sure we'll have a bunch to talk about.
My name is Travis Kling. I founded a crypto hedge fund called Ikigai Asset Management. We're based in Los Angeles. Come from a traditional hedge fund investing background. We spend most of our time in the liquid crypto asset markets, but also look at venture in the crypto space as well too.
Yeah, so to start off with, maybe where is the state of current crypto trading infrastructure, right? We've seen volumes drop off a little, but definitely there has been innovation in the space and there has been maturation. So what has changed in the past, 2 years?
I guess I'll start off. I don't have a super detailed history of the kind of evolution of financial markets over the last, call it 40 years, but based on my understanding, we're probably about equal to where equities were in, call it the year 2000. We have a lot of different now exchanges and clearinghouses. You have high frequency stuff works pretty well. You have derivatives, you have margin, all those things work pretty well. You have now even basic prime brokers out there, custodians, all that stuff works pretty well today. I think the probably biggest things that's still missing is like cross-margining liquidity across exchanges and just being able to be as capitally efficient as possible across many trading venues. I think that's probably the biggest structural problem today in the market. There's a lot of smart people working on ways to solve that problem. I think that's like the last really big thing that needs to work to get liquidity super smooth across the ecosystem.
Yeah, I agree. On the market side of infrastructure, we've made a lot of progress. Also custody, insurance, audit, a bunch of stuff that institutions needed just to participate in the owning or storage of crypto assets has made great progress in the last year or two. So I feel like that's certainly not fully mature, but there's not a huge number of barriers on the infrastructure side to participate as an institution in crypto buying, selling, trading.
One other thing that we were talking about when we were doing the kind of like the intro call for this panel was around data services for crypto investing. So when we were talking about the kind of the state of infrastructure, on one side you have like the infrastructure around dApps and actual usage of crypto assets for the intended purpose of the network, and then you have the infrastructure that's around kind of investing and trading. And I think we're talking about the latter at the moment, which in a lot of cases has come a long way. And one of the things I guess we didn't touch on is just like when I jumped into this 2 years ago, it was really hard just to get clean data, which is the type of thing that coming from traditional asset classes you totally take for granted. You have this Bloomberg terminal that has the price of everything ever going all the way back in time. It's got a language that seamlessly integrates it with Microsoft Excel, and it's just kind of like bingo bango. And then you start going down doing any kind of quantitative analysis in crypto, and you're just like, all right, let me just get some prices on a minutely basis. And then like all of a sudden it's like, well, what's the price of Bitcoin? Where are you talking about? Oh, it's got holes in it. Oh, it's, there's a lot of things I think you just take for granted in traditional asset classes that aren't necessarily the case, but even that has made a lot of progress just over the last 12 to 18 months with some of these third-party data services providers, both on-chain and on exchange. So.
Yeah, and I did kind of ask you this, but was there an incident in which you were burned? How did you have to structure yourself around it in kind of that meantime, because you have been trading in crypto?
I wouldn't say burned by anything other than maybe a little bit of money and a decent amount of time. It was more that we tried to do it internally at Ikigai in terms of ingesting and synthesizing raw on-chain and on-exchange data into a manner that is analyzable, which that sounds like something that wouldn't be that much of a lift, but then you start going through the AWS bill of getting it all in there, and then the man hours of scrubbing the data, and it gets to be a pretty heavy lift pretty quickly. And we kind of came to the conclusion that it's probably best left to just third-party expertise, unless you're probably a couple $100 million AUM type of fund and just have a really big data science team. So, and you're seeing those solutions come into the market, and there's a sort of picks and shovels infrastructure ecosystem around providing those data services to folks.
Yeah, so maybe let's flip it on its head as well, right? So the assumption is kind of traditional infrastructure is more mature for equities versus crypto infrastructure. What do you see from crypto infrastructure, improvements maybe in clearing settlements that's been played with? I think there's been news from Paxos about something that they're doing right now that the SEC is looking at. What from the crypto infrastructure space do you see potentially moving into more traditional assets that could improve those markets?
Yeah.
Moonshot view, potentially.
Yeah, I think the biggest thing is probably what Travis was alluding to is just clean data, robust access to all the exchanges. Today, if you say, show me a real-time view of all the order books across the top 10 exchanges by liquidity, to the best of my knowledge, that doesn't exist as a single API. And so just getting all that stuff in place, aggregated in one nice spot goes a long way. Mapping, for example, just even exchange flows. So all the exchanges have some well-known major addresses for depositing Bitcoin or Ether or whatever. But they rotate them on a somewhat regular cadence. And it's a cat and mouse game of figuring out when they rotate them, how they change their policies around moving coins between addresses. And it's not like the exchanges are trying to play tricks necessarily. They just they're internally optimizing their own balance sheets, how they think about transaction fees, because that's a cost for their business. And that stuff evolves over time. And there's really not a good mapping of that over time. And so understanding exchange flows, for example, which is really important in terms of price prediction, is actually a really hard problem. You just need a lot of off-chain data, and that doesn't exist in one place. And so, there's a lot of smart people working on this, but it's just a lot of manual labor of figuring it all out. We went through the same kind of exercise Travis did over the last year and a half of trying to do these things in-house, and we realized that it's just, you need a large operational team to get there. There's a lot of teams working on it, and then folks like us are helping, guiding those teams in terms of product development, and then kind of having our own in-house teams iterating on top of the tooling that is available. That's it's being worked on. It's getting a lot better really fast.
So my 16-year-old son is like a sneaker trader, like many 16-year-old kids. He's been, buying, selling, flipping sneakers for a long time, and he made some profit. And so sitting in a bank account, or first it was sitting in his bedroom in cash, and now it's sitting in a bank account that's not earning any interest. So we had to talk about 4 or 5 months ago about investing. And so he finally got Robinhood and attached it to his savings. Well, I had to do it for him because he's not 18. And he started learning about exchange-traded funds, and of course he knew about Bitcoin and Ethereum, so started buying some stuff. I think what will change, what will infect the traditional markets is the notion of market hours. I mean, just the fact that it was a Sunday and he's buying a bunch of cryptocurrencies, but he can't buy any equity or any exchange-traded funds because it's after market. I mean, I appreciate the systemic reasons for that, but it's anathema to global crypto assets.
Well, actually, before we get, do you know what was his total return on the sneakers?
Oh, he's made 3,000%. Yeah, he's doing. Yeah.
I need to change jobs.
There's a lot of asymmetry of information in the sneaker market.
And yeah.
Talk about a store of value. Sorry, what was that?
Oh yeah, so the original question before we went to, we should all be in sneakers.
Oh, no, I don't know. The only thing that I was thinking about was just like, these are all sounding like first world infrastructure problems. Like, it's just to take a step back, it's like, we're not talking about 2014 where somebody literally stole all of your Bitcoin, right? Or even 2017 with like coin check hack or something like that. Like the state of the trading related infrastructure in the crypto ecosystem has made significant strides over the last 12, 18 plus months. And now you're talking about more of, window dressings and nice to haves and like, now I want my exchange to give me, iceberg orders and TWAP working, and like I want that to be cheap and free, and a lot of the biggest building blocks I think have been put in place. So the sort of barriers to entry for the herd to go and buy Bitcoin at this point are pretty well removed, in my opinion. Yeah.
I'll echo that. We launched our first fund on October 1st of 2017. At the time, we were self-custodying all of our assets, and I remember like we had a whole process around sharding the keys and everything. I mean, it was actually pretty scary as a fund manager. Everyone knows I've got a lot of someone else's money. But like today, operationally, those things are all sound. You've got big four audit firms, like fund admin, custody, those things are all like objectively solved today. A lot of the sponsors here right outside, like I think BitGo, Anchorage, a lot of other folks, like they solve all of these problems. They do it very well, and they do it pretty cost effectively. The next problems Travis and I have been talking about are really like, okay, as hedge funds seeking alpha, how do we, find those insights, right? But in terms of just kind of core operations, like the market now runs pretty smoothly.
Okay, great. And so one thing I was curious about, so the credo of decentralization of a lot of blockchain is decentralization, democratization. How do we get all this information out to everyone in a way? And so one thing that hasn't really developed much is decentralized exchanges, and I think there is some work there. And so how do you guys think about that? How far into the future do we see that happening? Do we think that could happen when we look at larger institutional players that tend to prefer on kind of a theological level, more private, more control over their information and their money?
I guess I'll weigh in on this one first. So there's so the idea of a decentralized exchange is really interesting, where counterparties can post limit orders somewhere, maybe on-chain, maybe off-chain, but then ultimately settle those trades on-chain where the exchange itself never takes custody of the assets. It's a pretty revolutionary idea, and it's a really big idea. A lot of people have been working on this. People started trying to do it in Bitcoin in 2013, this protocol called Omni that really was way too far ahead of its time. A lot of teams have been iterating on this idea in the Ethereum ecosystem. There's now some small scale success, call it on the order of $10 million a day of liquidity goes through those platforms. So it's working, but there's clearly a lot of still structural reasons in terms of latency, throughput that really aren't there today. There's a lot of super smart people working on these problems in all kinds of different ways. My expectation is over the next couple of years, you'll start to see those things become meaningfully usable, that a market maker who wants to have limit orders and have latency of sub 1 second for everything will be able to function. I don't know if you're ever going to get HFT, sub 50 milliseconds working really well on a decentralized exchange, but even 1 second is pretty good for a lot of market makers. Spreads will be a little bit wider, but probably not too much worse. And I think we're probably a couple years away from that. And when that happens, definitely there will be a market demand for it. All the people who trade on BitMEX today, right, and BitMEX is the most liquid venue for USD Bitcoin in the world, the single most liquid venue. I think those people have a pretty strong interest in trading on a platform that's as decentralized as possible. So I think there will be demand when the solutions are there, but solutions are still a little ways to go.
I have a very similar view, but I think one thing that's gotten lost or was lost early on in the emergence of whether it's a centralized or a decentralized exchange is that most of the decisions behind buying and selling today have humans, and humans are still looking for reputation, trust, speed, convenience. And those things matter, and so I think a few of the more centralized exchanges were able to establish that convenience, liquidity, speed of transaction, customer service, both for retail and institutional. And so I think that not just the maturity of decentralized exchange technology, but let's call it the reputational infrastructure around it will need to emerge to see sufficient volumes move over. But I do believe it happens, and I think probably on an order of several years makes sense.
I guess two things kind of come to mind. One, you got to ask yourself, is the market demanding this? And the market's actually demanding the other direction, which is as a fund manager, my LPs or potential LPs want to make sure that I have a third-party custodian. And so there's this sort of weird thing that's going on in the evolution of this ecosystem where this promise of self-sovereignty and own your own keys, it's at the institutional crypto investing level, which I'm not entirely sure what that means, but at that level, they actually want to make sure that you don't have control over your own keys so that I can't run away to the Seychelles with their money and never come back again. And that's the state of the sort of market right now, where there's very little demand for the kind of self-sovereignty that goes along with decentralized exchanges, and the pace and direction of what that demand may look like in the future falls into the bucket of what we're now calling dissident tech, which I don't know how many people have ever heard that term before, but it's been something that's been getting a lot more traction in my circles over the last few weeks, which is just the concept of trust is evolving pretty rapidly in the United States and globally right now, and that's a really big picture thing to say, and it wraps up a whole bunch of things, and it's outside of the scope of this topic of conversation, but to the extent that the market desires the ability to be more dissident, that self-sovereignty concept is wrapped up into that, and decentralized exchanges, the demand or lack thereof of those is probably going to be a function of the direction and the magnitude of how much people or the world in general kind of goes in that direction. So.
Yeah, and one thing I think we wanted to turn to is a space that maybe infrastructure hasn't been as focused on, that we haven't been as focused on in terms of infrastructure investing, the dApp space. And David, you actually do have some really interesting experience there. You invested in CryptoKitties, which early on was very interesting, had a lot of interest from consumers actually on the space of being able to trade these really cute little cats, and they could be octopus kitties. And so tell us a little bit about how that has developed over the past 2 years or so, or lack of, right? And how that space does need actually a lot of help.
Yeah, sure. So I think it's helpful to remember that I like to think of the entire crypto ecosystem really in two big stacks. The real first generation of innovation was around a Bitcoin first, and then multiple crypto assets that are bought, sold, traded, and a whole bunch of financial infrastructure, which we just spent 15 minutes talking about, needed to be built to support the financial service needs of that entire industry. And we're not finished with it, but it's much more mature. But then largely a catalyst of the Ethereum white paper was this notion of, well, actually, there's even more that this amazing innovation can catalyze, which is this decentralized approach to building applications where compute is decentralized and the other commodities required to build and scale applications also get decentralized, like storage or data transfer or bandwidth or specialized compute. And that is super immature market. And the catalyst maybe for seeing this happen, one of the first most popular dApps or decentralized apps was CryptoKitties, which was an experiment launched by this company in Vancouver that took a digital piece of art, effectively a kitty, and put it on the blockchain, and they had to make a standard around that, which is an NFT, a non-fungible token. So each cat or each asset is itself a token, and they can be bought, sold, and traded, but ownership is written to the chain, so there's proof that you own the digital asset, and you can do things with it, like use it in a game or take it with you elsewhere. What was novel about it was that the ownership is verifiable on a chain and is independent of the company that created the asset, which is very different from virtual items or virtual currency used in gaming today. You can buy a gun or a cloak in Fortnite, but if Epic Games decides to take it away from you, they can, or if they decide to increase by tenfold the number of versions of that, and suddenly your value goes from $1 to 10 cents, you have no control over that. That doesn't happen in the NFT world. So the problem with the experiment was that it was very popular. I don't know, a couple million people bought cats, and it's still, maybe thousands of people a day are selling, maybe 10,000 of people a day are buying, selling, and trading these cats. But what happened was it broke Ethereum, as many of you know, in December of 2017. It was just not a network that could scale to support this many transactions. So that led to a race of a whole bunch of very smart people making improved layer 1 smart contract platforms that could handle scalability or dApp needs. And there's a lot of progress that's been made there. There's at least 10 super credible projects that are vying to supplement Ethereum's lack of current scalability. However, there's a whole bunch of other infrastructure needed between a layer 1 smart contract platform and a dApp to make your dApp decentralized. And this is one of the most interesting investment theses, I think, largely in the space, because Web3, as this whole nomenclature refers to it, could be massively transforming to the way all web-based apps are built today. So we've invested in a couple different pieces of this stack, and I think it's a super immature stack. I'll just give you one example. If you build a decentralized app today, and there are tens of thousands of them, maybe only a few hundred or thousand that are really active. It's super early, but not only can you decentralize compute and utilize a blockchain to do your compute, you have to decide where you store your data. And in Web 2, that was easy. You just stored it in an Amazon S3 cluster or in a MongoDB database or something like that. But that would be centralized, and that's sort of anathema to the Web3 ethos. So how do you store data? Do you write it to the chain? It'd be super inefficient. Like if you built a social network and every picture that people uploaded was written to the chain, you wouldn't do that. So there's a company that we invested in called 3box, which is a decentralized storage layer that has a bunch of nodes, and you can store data decentralized on the network. And then it also has an identity matching layer, a protocol, so identity can also be self-sovereign. I think this is just one example of a critical piece of infrastructure that's lacking today.
Yeah, and how do you guys think about it, Kyle?
Yes, I think David did a good job providing kind of global context. We've made quite a few investments in the Web3 stack, definitely all still very early. A number of them have some pretty meaningful traction now in the ecosystem, but the end user applications are not quite there yet. I wrote a blog post about a year and a half ago called the Web3 Stack that tries to kind of, if you watch like iOS and Android presentations from Apple and Google every year at their respective keynotes, they kind of talk about like the respective stack for iOS and Android, and like the number of people at Apple and Google who are actually making those decisions about the architecture of the operating system as a whole is very small, on the order of like 5 people or so, making kind of those final decisions. And then they like present these nice diagrams of like the Bluetooth modules and the GPS modules and how the screen renders, and I mean all these things have to come together, right, to like make your phone like work the way it does. And the funny thing in the Web3 stack is that there is no master architect. The actual development and evolution of the stack itself is decentralized. And so folks like myself spend quite a bit of time understanding how these different applications can theoretically work, understanding what are all the pieces required to kind of produce that outcome, and then kind of systematically identifying the points where we think value will capture in that stack and investing accordingly. I think we've made probably a dozen or so investments at different layers of the stack, all the way from key management for consumers through querying data out of these systems. And so yeah, it's a super interesting space. A lot of long-term implications, I think, for kind of how people own their data. But it's still pretty early, and it's harder, admittedly, to see where this all goes. But we're still excited about the thesis in the long run.
Both these guys know a lot more about the intricacies of that stack than I do, so I'm actually going to take my little bit of time and just ask them another question. So like you mentioned 2 years ago with CryptoKitties that sort of overloaded the Ethereum network. So 2 years ago, Ethereum didn't scale, and there were a dozen quote-unquote ETH killers coming to eat ETH's lunch. And then here we are 2 years later, and ETH still doesn't scale. And of those dozen ETH killers, it looks like a couple of them exit scammed, and a couple more still haven't launched a product. And the only thing that's more sad than ETH's network usage statistics, which are sad, are the network usage statistics of any of the competitors, which are abysmal. And I don't come from a tech investing background, so I don't have that good of a frame of reference for what the appropriate level of expectation of the pace of innovation should be for this stack or for the layer one of this stack. But over the last 2 years, there's been billions of dollars poured into these competitors and hundreds of thousands of developer man hours, and we have very little to show for it in terms of actual real world traction where anyone outside of this little bubble gives a single shit about anything that's being built on top of any of this stuff. So my question is, what is the appropriate expectation for the pace of innovation on this stack?
Yeah, I don't disagree with anything you said. I think that is an accurate qualification, which is why you really have to follow the VC axiom where venture capital is the triumph of hope over data. I think it's too early to make traction-based bets in the Web3 stack, with a few small exceptions. We're talking about a small scale. One of the things that excited me about 3Box was that they still have somewhere between 400 and 1,500 NPM installs a day of their dev kit. Okay, so that's not massive, but it's consistent developer activity for a developer tool. And they've got, scores of live dApps today that use them, but it's progress. So I think you first have to, I think your question is, what is the expected pace of software development? I think we know a lot about the complexities of software development, and there are very few projects as large as layer one smart contract platforms. It's super hard tech to do. It's also super immature technology. It's not like you can hire thousands of engineers who have built 5 of them before, right? You're often solving novel problems to achieve scalability, and no one's demonstrated it yet. So look, it's early. I think some of the smartest investors in the space who have been looking at it longer than I have taken a portfolio approach for exactly the reasons that you're saying. They're not betting on one particular ETH killer. We've been looking largely above the layer one smart contract platforms, letting them duke it out, but knowing that a bunch of other pieces of tech will be required, and those pieces of tech can scale across or operate across multiple chains. The last thing I'd say is I can't tell you what the right expectations of time are, but the biggest thing that's guided us is, well, I'll say it this way. The Pew did a bunch of research on why Netflix is popular. And the number one reason Netflix is popular, they surveyed statistically significant tens of thousands of people, is there are no commercials. And the number 2 reason is I can watch whatever I want to watch when I want to watch it. And number 3 is I can binge watch it. And number 4 is I like the shows. So the first 3 reasons why people love Netflix are because it solved all of the problems of TV. It solved the objections that people have of television. We don't like commercials, we don't like appointment viewing, we don't like the episodic nature. Well, I mean, not that we don't like television, but we like more this other model. So the question that drives a lot of our investment decisions is, what is it about Web3 that solves the problems of the centralized architecture? And I think there are very few good answers to that today, which is a reason to be super skeptical about some Cambrian explosion in dApps. What is it about gaming done on blockchains that will be better than centralized gaming? And personally, one answer I like a lot is NFT ownership. Like, you can collect baseball cards online and be sure that no one can revoke your ownership later, and that nobody can devalue you by, releasing more stuff. And there's massive demonstrated interest in virtual items today. So I don't doubt your skepticism, but I think you got to look for some evidence about why the future will be better than the past.
Yeah, I'll add kind of an additional framing on David's view. So a lot of people in crypto like to talk about censorship resistance. And for the use case for Bitcoin and for kind of sovereign money, that's pretty intuitive why that's valuable. And a lot of finance-oriented folks kind of understand that pretty intuitively. It's harder to grasp that for, call it, like web application type things. I'll use myself as an example on Twitter. So I've got 35,000 or so followers now, but somewhere between 25 and 30,000, my rate of growth of followers just fell off a cliff. And I was kind of curious why the rate of growth slowed so much. And a lot of my peers, their kind of rate of growth I just noticed over time kept continuing. And so I kind of Googled around and dug into this, and I can't prove this, and I haven't called anyone at Twitter or bothered to investigate it, but I'm pretty sure what's happened is like crypto Twitter is just filled with a lot of trolls, and people like to hate on you because they disagree with your investment thesis for X or Y or Z. And so a lot of people have just like reported my account as like, spreading false information and abusing other people online and whatever. And like those claims are just outright not true, but a lot of people have just gone in and done this. And so Twitter has effectively shadow banned me in the sense that like they no longer recommend my account to other new people who are getting in the crypto space. I have zero ability to control this or do anything about this. And I've reached out to Twitter customer support, and they just give me kind of blank answers. They don't help. And so one thing I've kind of observed is that for people who are, the general rule of thumb of the internet is 1% of people create, 9% comment, and 99% or 90% consume. It's kind of the general rule of thumb. And this is true across like Reddit, Twitter, Facebook, all major, Instagram, all the major services. And the censorship part, right? If you're in the consume only, which is 9 out of 10 people, you don't really experience the censorship problem directly. But for the people in the 1 or 2% who are producing the majority of the content, like that actually is a very real problem to them. And so today, to me, Twitter is actually like a painful thing because like something was working, I don't think I've changed anything, and like the algorithm broke in a way that is totally opaque and not understandable to me. And so I am actually interested in some sort of alternative where you can break censorship. The same is true for a lot of creators across a lot of platforms. And so I think one of the unique opportunities for Web3 is basically breaking that. Because one of the promises of Web3 is that the applications and the data are not bundled together. And so if people are unhappy with the application interface, they can switch to new front ends, change the algorithms, and all kinds of other cool things. So it seems like a very first world problem, and I understand I'm not like the most, my example isn't super relatable, but I can promise you for a lot of creators across YouTube, Twitch, any major of the online platforms today, people who have reach and influence, those people are overwhelmingly feeling these issues. And it's basically, I don't mean to hate on Twitter, it's just an intractable problem. When you have 1 million people say this person's a fraud or a scam, like how does Twitter like objectively verify that in a global way across 300 million users, right? It's actually a super hard problem. So there's a lot of really interesting opportunities, and as disinformation on the internet, as reputation on the internet, as these things become more and more pervasive in the world, which is pretty clearly going to keep continuing, more and more of these kinds of opportunities are going to exist for folks doing interesting things online. And that's why we're really bullish Web3.
Yeah, that drives at a really interesting problem with kind of algorithms and data sorting. And so I wanted to pivot a little, and I'm going to open up to the room for questions in just about a minute. So if you have any questions specifically for any of our panelists, please keep them in mind. But I wanted to think about something else a little separate about investing in general, just investing in crypto. So one thing from more traditional circles in the world is the idea of the recession is coming. We are going to be in a recession eventually I don't know, maybe next year, maybe the year after. Maybe it's not going to be as bad as 2008, 2007. But crypto was born out of the recession, right? It came after it. It was kind of a reaction to the level of lack of oversight into these major institutions. What happens to investing in the crypto space, right? Traditionally, we see a little bit of a lull in VC investing and investing in smaller companies in this space. And crypto is in that smaller bracket. So what happens to crypto investing when the next recession comes?
I think there's two broad ways to think about it, lots of smaller ways, but if the recession is inflationary or deflationary, it's kind of the broad-based way to think about it. If it's an inflationary recession, that's probably good for crypto. Certainly good for gold. And given that, yeah, some people will still rule out crypto, but crypto is just such a small base relative that it's probably good for crypto. Digital scarcity will make more and more sense to more and more people. At some point, you'll see some big global macro hedge fund managers come out and say, I bought a bunch of Bitcoin. That can become very reflexive very quickly. And so if we have an inflationary recession, which given the level of quantitative easing among central banks around the world today, that seems like a real non-zero probability to me. If we end up in a deflationary recession and everyone just goes risk off, there's an argument that's bad for crypto. There's ways that it's good depending on how you look at kind of capital movement between countries and such. But certainly in the case of an inflationary recession, that's, I think, just slam dunk use case, opportunity for crypto.
The single biggest global macro factor that's going to affect the likelihood of a recession over the next 18 months is what happens with the China deal. That one's a pretty hard call to make. The euphoria that we saw in traditional asset classes over the last month or so was a response to a sort of first phase of a trade deal that wasn't really that much of a trade deal at all. But to the extent that situation, the tensions around it don't rise, then the likelihood that we're going to go to a zero growth like global GDP situation in the next 18 months or something lower than that is pretty small. And the main reason for that is because the whole world is cutting interest rates and juicing quantitative easing more or less at the same time. And I think that the sort of trickle-down effect to that into first traditional VC, which is like having a bit of a hiccup right now with some of these unicorn valuations, some of these IPOs in 2019 that have performed pretty poorly out of the gate, the WeWork debacle, and there are some folks that are kind of calling for some sort of like potential for a secular bear market in traditional VC for some period of time. It's hard for me to imagine that when every central bank in the world continues to press on with the largest monetary experiment in human history. Quantitative easing just sort of warps asset price discovery and pushes people out on the risk curve in a way that makes them look for returns in places that they otherwise wouldn't. And that's just going to keep money pouring into traditional VC, and crypto is going to be the sort of tangential beneficiary of that. So,
do you have any thoughts on that?
I'm not a macroeconomist. I'm a hardware and software engineer, so I won't.
Abstain. Okay, great. So we'll go ahead. We're running a bit short, but I'm going to open up the room for questions. If you guys have specifics, please do raise your hands. Would love to hear. Yeah, there's a gentleman back there. Or...
So I think that any disruptive technology will basically fundamentally change the process by which things are done, right? And I think implicit in a lot of discussions around crypto infrastructure is that the current market participants that exist will kind of be one-to-one mapped to these new blockchain-based applications, right? And a good example is just DeFi lending. In DeFi lending, there's no such thing as a custodian or a settlement agent or a transfer agent or a fund administrator or a fund manager or any of those kind of parties, right? So I would be interested to know what your thoughts are around investment in crypto infrastructure, given that I think it will entirely replace the need for all these intermediaries that currently exist, and kind of where you see that developing going forward.
I guess I'll add some colors. So I think there's a lot of interesting opportunities to invest. I agree that the service providers like the ones you mentioned are I think, unlikely in crypto to have a place in the long run. But for example, let's take a protocol like Compound, which is on Ethereum today. Very interesting. Not really at a huge scale yet. There's probably about $50 million. Compound is a money market. You can deposit any asset on the Ethereum blockchain into it, collect interest. Anyone on the other side who wants to borrow the asset can post collateral and borrow the asset. Today, the primary use for Compound is going margin long ETH. And I think there's about $50 million or so that have been borrowed that are outstanding today.
It's also centralized and requires trust.
I don't know. That's shit. We're not a compound investor. We have no affiliation to the team, but there's no custodial agents. That protocol, though, by definition, has to draw a spread between borrowing and lending rates. So there's an interesting opportunity there to kind of monetize the system in a unique way that's kind of crypto native to the protocol. I think those are the kinds of opportunities for investing in financial infrastructure that, yeah, doesn't map to traditional types of businesses.
Well, I run amberdata.io, and we combine blockchain data and crypto market data into a single API. And I'd like to invite you guys to check that out.
Cool.
Oh, sorry. So we are actually cut on time. I apologize if anyone else had questions. But thank you so much for having us on the panel today, and thank you all for joining us.
Thank you.